a massive hot topic at the moment, obviously, COVID-19. And so the idea of this session was effectively to have a conversation about, well, what are the financial reporting issues, not only for 31 December, but going forward for, March, June year ends, and also from an auditor's perspective. So what sort of issues are they looking at? What sort of issues may you face? So it's applicable to both people preparing accounts as well as auditors. So obviously you know me. My name's David Holland, and I'm the National Head of Technical Accounting here at Moore Stephens, and also a board member of the AASB. But my co-presenter today is George Darkus, and George has obviously got a lot of experience for those of you who know him. He's our chairman of the Audit and Assurance Committee, and it's a really important conversation that it's not just about financial reporting, it's obviously all about the audit implications as well. So that's where we've got George involved in the discussion. Well, what's the background? And, this is, I guess it's an understatement, my second dot point, that the situation is constantly changing. The first we heard about this outbreak was around that December, January sort of mark, where people talked about a new virus and coming out of China and what did that really mean. So that developed in December, although the virus itself wasn't identified as a coronavirus until the 7th of January. And the WHO, or the World Health Organization, officially declared it as a public health emergency on the 30th of January 2020. And in my mind, particularly, that becomes a very important date. And then the 11th of March, they came out and said that was a global pandemic. Now, people prior to that date had effectively said, whether or not you called it that, that's what it was. And this becomes important in our timelines when we start talking about adjusting events, non-adjusting events, etc. And also about the progression of where we're at. So I'm by no means a medical expert, but if you look back through history, it seems to be that, everyone talks about the Spanish flu outbreak in 1918 that killed 50 million odd people. But on a regular occurrence, it seems to be between 7 and 10 years, some sort of a flu respiratory virus comes out. And you can think recently about SARS, swine flu, bird flu. One I was watching the other day where they were talking about the Hong Kong flu, which I think came out in the 60s or 70s. It might have been the second deadliest behind the Spanish flu. So each time one of these viruses appears, the concern is how virulent is it? How deadly is it? What effect it's going to have? And I think one of the most challenging things in this outbreak, and people are still yet to make decisions about some of those things, is the level of government intervention seems to be much higher than it's ever been in its history. And so that has real implications for not just people, but our discussion today is obviously around financial reporting, companies, audit implications, going concern, etc. So I think if you look back through history, it's very unusual for governments around the world to shut businesses down, to create lockdowns, to stage things. Every second night we hear something come out and, there's a new group of businesses that are affected or shut down, etc., etc. So these businesses by themselves could have been successful businesses, might have not been impacted, but they're being shut down by the government as a public health issue. So that, I think, creates a unique set of circumstances for us from an audit and financial reporting point of view. So that's as best as I can describe the history. And the history is important when we then make financial reporting decisions. So the first group of people here that are affected by this are your 31 December 2019 year ends. And that's where you look particularly at this timeline. That in December there, and very late in December, an outbreak of some description was, reported. There was no discussion, was there any human-to-human transmission? Was it just an isolated outbreak, etc.? And you can see that changed dramatically once we came around to January. So the first question you really have to think about is, well, is this an adjusting or a non-adjusting event? So if I'm preparing my 31 December 19 accounts, and we'll talk in forthcoming slides about it, but things around fair values, impairment considerations, expected credit loss models. To what extent do I look at this coronavirus and include it in those assumptions, or to what extent do I say that's a non-adjusting event that requires a disclosure? And where the technical community has really landed on this is that there was no explicit evidence of human-to-human transmission as at 31 December. Yes, it was a virus. As I said, history is littered with viruses and respiratory illnesses and things like that. At that point in time, it wasn't, that evidence was not known. And so the general consensus is that this is a non-adjusting event for 31 December 19, which means you're particularly looking at disclosures. When we talk later on, and I'll just flip between a couple of slides before we get there, it then becomes much more important that at 30th of January, so as early as a January year end, which there won't be many, but if you roll that forward March and particularly June, that this will no longer be considered a non-adjusting event. So for instance, declaring this as a pandemic on the 11th of March probably isn't as critical a date as 30th of January, because by that stage, human-to-human transmission had been confirmed, it was a public health emergency, and you're now starting the thing, the classification as a pandemic is really just providing additional information or clarifying conditions that existed. So the real cutoff here seems to be 31 December in my mind, that for 31 December, you're looking at non-adjusting events, and for year ends after that, you're now looking at adjusting type events. Disclosure requirements, and every week, I think probably what you're going to disclose is increasing because the ramifications are growing, you know, on a daily/weekly basis. And so if management considers the impact on the business and the control measures put in place are going to be material, then they need to make some disclosures. So I think we're going to, and we're already seeing it in the listed market, where there's announcements coming through as part of the continuous disclosure regime about, I think I heard one this morning, a large retailer saying that they'd laid off 9,000 staff and they had no intention of paying rent to the landlords over the forthcoming, I don't know whether that was a month or 2 months or what amount, but they'd actually then gone further to say, we don't intend to pay our rent. So, you know, those sorts of disclosures are obviously going to be very important in the financial statements. A lot of people, George, have you got something you'd like to add to that discussion?
Yeah, I just want to add, David, from an audit point of view, we're seeing this clearly as a huge discussion point at the moment, and the answer is quite different depending on the nature of the entity. So we're almost having conversations, for example, where clients are saying, well, we don't think this is going to materially impact us, and they've made some form of assessment. Obviously, a lot of uncertainty in relation to that, but even if you don't believe it's going to materially impact you, which is probably going to be extremely rare, the very fact that you don't think it's going to materially impact you is a disclosure item as well. So we're almost having conversations with clients around it's such a significant issue at the moment that some form of disclosure, whether it's material or not, or expected to be material or not, is almost irrelevant now. Stakeholders and users are trying to understand from a listed perspective, from a private company perspective, from a not-for-profits perspective, depending on who's reporting at this point in time. There's an expectation that the financial report would have some commentary around this scenario. And what we're seeing is obviously the subsequent events notes being a little bit more detailed than what we've seen in the past, a little bit more prescriptive to the extent that it could be, and a little bit more thought processes around what should be talked about, what specific account balances might be impacted, but then saying we just can't reliably measure what we think that impact is. And then there's degrees of emphasis of matter in audit opinions that we're starting to see, depending on the size of the issue, depending on the nature of the issue. Some auditors are not emphasising in the audit opinion. Some auditors are emphasising in the audit opinion. It just really depends on a case-by-case basis. So I think this is really going to be a really critical part for 31 December, even though it's a subsequent event. But even this morning, for example, talking about a client in relation to deferred tax assets that are sitting there for tax losses, and they've made a profit in up to December 2019, but the situation's changed significantly after that. So a bit more disclosure around that is probably what we're going to be talking about. So that's sort of what we're seeing from an audit perspective, David.
Yeah, no, that's great comments. Thanks, George. So then we start to get to fair value measurement. And in the past, I was asked this question a lot, but obviously this has now heightened it, in that if your client has shares that are based on ASX listed prices, and at 31 December, those shares might have been $2 and now they're $1, you know, for a lot of companies, there's a 30 to 50% drop in their share price. What share price do you actually use? And as counterintuitive as it might seem, you actually use the 31 December price. So the 31 December price is a level 1 fair value, and it's in an active, provided it's in an active market. The only caveat I would put on that is if, you know, if for some reason that share price isn't actively traded or it's got thin trading issues, etc. But for the vast majority of shares that are held on the ASX, the 31 December price will be the price that goes into those 31 December. Now, once again, there would be significant disclosures around the drop in those fair values. So if you're signing off a set of accounts now and you know that, you know, those share prices have dropped 30 to 50%, there would be significant disclosures around not only what that number is, but the impact of what that number might do to the company, particularly managed funds and other funds. Go for it, George.
So David, so this is a good example of the note when we're talking about 31 December, having examples where there are certain things that are going to be unknown, so therefore you can't quantify, but there will be other things that you will know that you can't quantify. So if you have a portfolio with listed prices or predominantly listed prices, there may be an obligation in the subsequent events note to actually put some detail in it. But I want to also look at it from a flip side. Can we just flip this and say, if you're a listed entity and you are one of those entities where your share price has dropped out, we now have an issue. If we're now going to go to going concern, which we're going to touch down the track in this process anyway, if you're a listed entity and your share price has been impacted, but some of your going concern assumptions was that you're going to raise some funds in 2020 and your share price has now been shot, there's now questions about how reliable is the ability to actually raise funds over the next year or two. How dependent were you on raising equity in the next year or two, and what impact may that have on the going concern of your organisation as a whole? So there's two ways to look at this. One, if you're invested in listed entities, or two, if you are a listed entity, you need to think of it from both ends.
Yeah, for sure. And that leads us to that impairment of assets. And sometimes people, as a basis, are saying, you know, compare what the market cap of a company is for some of those companies too, about triggers for impairment tests, etc. So for your 31 December, the assumptions are still going to be based on 31 December. So similar to the adjusting, non-adjusting argument, you would look at, well, what conditions existed at 31 December when I'm running my impairment test. But at the same time, you're casting an eye, as George has been highlighting, about, well, now what are the implications and what are the likely ramifications as best as they know it, you know, on what the coronavirus is going to do to their organisation. So, I mean, one example that we put in here was things about panic buying consumption patterns and control measures. And I guess it's where, you know, when we're talking about this, not everyone's necessarily a loser out of this. You hear that some of the supermarkets have, you know, sold 6 months worth of stock in the space of 3 or 4 weeks. So, you know, revenue obviously through the roof for them. But for a lot of other people, what does that mean? And maybe people supplying into the supermarkets, etc. That might impact what some of their assessments are. But these would be non-adjusting events in that scenario for your 31 December. The ECL model So the ECL model, we're just starting to get our head around. So AASB 9 financial instruments kicked off last year for most clients. And the ECL model is one that we apply to receivables and debtors, or debtors for want of a better word. And so people are looking at that and saying, okay, well, the ECL model was brought about effectively after the GFC in 07 and 08. And the discussion there was that the incurred loss model was too slow to react to some of these, and that the expected credit loss model, as its name entails, is more about expectations. So one of the most common questions I get asked is, well, how does COVID-19 fit into my ECL model calc when I'm looking at 31 December? And it really depends on your view of the world about how you view, I guess, viruses and pandemics. So if, as part of the ECL model, you don't only look to the history, so you don't just say, well, you know, over the last 5 years, my expected losses on debtors or whatever. You then look at current market conditions, industry factors, government intervention, etc. But those are all at a point in time on 31 December. So a lot of these conditions didn't exist. Government interventions, lockdowns, etc. didn't exist at 31 December. And the strongest technical argument is that they therefore won't be factored in. Some people, however, take the view and say, well, really, did it just provide additional information about uncertainties that existed? So, for instance, if you view this as a virus that happens every 7 to 10 years, some are worse than others, should that be factored in? And the other really big question you've got to ask yourself is the bankruptcy, was it already, well, let's say someone goes bankrupt or can't pay, was that based on a condition that already existed, or was it only brought about by coronavirus? And that's a pretty tough judgment call. One of the companies I heard who went into liquidation in the UK was a car phone set of stores. And the discussion was they'd been making losses of £90 million for the last couple of years. The business was not going well. Coronavirus, last nail in the coffin, they decided to shut up shop. So arguably, you would factor that into your 31 December calculation, as opposed to a business who's very strong, going really well, and based on this government intervention has now, you know, shut up shop. Well, that's a very different discussion about what gets factored in or out. So it still is a bit of a grey line and a bit of a judgment call about what you include and what you don't. I guess, you know, the conservative nature in most of us would say, if in doubt, then you'd probably factor that into your ECL model. George, you want to add something?
Yeah, David, just from an auditor's perspective, I don't know if everybody's aware, but if you look at the IBIS World, so IBIS World has issued on the 12th of March, effectively an economic assessment called IBIS World COVID-19 Economic Assessment as of 12th of March, and it basically goes through it from an industry perspective. So from an auditor's perspective, the things that we're going to be looking for, particularly around fair values and also ECL models and the state of the economy in specific industries, because it will make sense now that, I guess, when we did ECL models or we did fair value assessments of specific assets, maybe properties, we did look at it from the nature of the asset rather than the industry to which the asset actually relates to as well, and looked at its historical events. But if you read this IBIS World, and I suggest if you haven't seen it, I'd start getting it. What it really does is goes from an industry by industry a state of play, and has a bit of a prediction, as much as you can predict at this point of time. And there's no doubt that that will be updated on a regular basis. And from an auditor's perspective, there's no doubt, even within people's client base, that there's going to be different industry sectors within those client bases. So being a bit more specific and detailed compared to what we probably would have done in the past is probably something that I'm going to see a lot of in relation to debtors or financial assets, investments, and even your fair values of your property assets as well. So again, if you haven't seen that document, it's a really good document. It's a really it's starting to be a bit more detailed. It does go by industry, and it's a good sort of sense of where they think the industries are going over the next 1 to 2 years. Thanks, David.
Yeah, no, fabulous. So what's ASIC doing at the moment? So the first announcement that ASIC's put out in relation to this is around 31 December balance date AGMs. And ASIC has said it will take no action if people delay their AGMs out till the end of July. So effectively a 2-month window or extension, but without formalising it. So it didn't come out other than they won't take any action. The other thing that they made quite a point of in that release was to say they support the holding of AGMs using appropriate technology. So obviously going forward, the 4 metre square rule, you're not going to get many people to fit into your AGM for that. And if there's a lockdown, no one's turning up anyway. And as the government said, this could go on for months, not necessarily weeks. So even the 31 July extension might not be long enough for an AGM. So I think we're going to see a lot more people similar to today where we're doing a webinar, is whether or not people are going to look at virtual technology for holding of AGMs or other means, and ASIC fully supports that. So they've written a bit of a blank check there to say, you come up with a good idea. If it's reasonable, we support that. The ACNC at the moment has said that many people have already submitted their information statement, but rather than make a blanket extension, they've asked that people actually request for an extension. So a little bit more onerous, but if you've got issues lodging your annual information statement, then you need to email the ACNC. It would seem highly unlikely that they would reject any reasonable request on that. Now, both of these organisations are obviously going to continue to watch this space, and we do quite regular alerts on LinkedIn, etc. So you can follow myself or George, and any updates around this ASIC or ACNC requirements, we'll post on real time in that LinkedIn forum. Okay, we then move on to where I would draw a line in the sand. So, as I said, if we go back, if I speed back to the background, pretty much every major accounting firm's put out an edict that for 31 December, most people are considering this to be a non-adjusting event. Where you then get questions is, well, when does it stop being a non-adjusting event and becoming an adjusting event? And so the latest anyone could ever say that is the 11th of March. So once it was declared a pandemic, there's obviously no room to move. So the only year ends that have a question mark around them are really January and February. And my opinion is that the WHO officially announcing this as a public health emergency on the 30th of January was enough of a trigger point, such that any year end after that 30th of January date, it's now going to be an adjusting event. And so really, when you think about that, you go through all the slides that we've just talked about. So it's now an adjusting event. ASX listed prices, particularly if you're in a March or beyond year end, have factored in the massive fall. And, some might say it's been overreacted to. If you're a day trader, you could have made $1 million or lost $1 million pretty quick. One day it goes up 10%, the next day it drops by 10%. So huge volatility. What is the right price? I guess we'll only ever know in hindsight. But the ASX listed is still considered to be a level 1 fair value, and that's the value that should be used, with the caveat that there's no, thin trading or other sorts of issues. When we say it's likely to be an adjusting event, well, now it's also going to be an adjusting event for things like impairments of assets. It's going to be an adjusting event for ECL models. So it's now something that has to be factored into every one of these calculations, and it will result in changes in the numbers. So a non-adjusting event is really just a disclosure, whereas an adjusting event is changing your balance sheet numbers, changing your P&L numbers. impacts actually in there. You now have evidence of government intervention. So shutdowns, lockdowns, closures of businesses. So if the government shut down your business and you've got perishable stock, you've got inventory net realisable value type issues. Onerous contracts. It'll be very interesting to see what happens, like that market announcement today saying we're not going to pay the lease. So if you're not going to pay the lease, where does that leave? And the latest I heard is that the government's thinking about what the implications are for landlords. Are they going to provide assistance to landlords not to enforce leases over this period? We'll have to wait and see. So that's still a little bit of a moving target about to what extent will leases become onerous if you're shutting down shops or venues, etc. And ASIC has said that they'll continue to monitor the situation for entities with 31 March or 30 June balance dates. So they haven't, and I think one of the reasons they haven't gone too early is we don't know at what stage we're going to be at. I think we're at stage 2 according to the government's plan. New South Wales and Victoria were talking about going to stage 3. I think stage 4 is the complete lockdown, so I don't think there's a stage after that. But obviously, ASIC needs to wait and see what stage we're at, how long those things are implemented to then make decisions on these year ends. George?
David, I guess from an auditor's point of view and just pre-planning March, April and June, it really is going to be, I would suspect most auditors will take the approach, the default position on asset values, whether it be fair value of properties, inventory valuations, whether it be listed shares or investments and goodwill and intangible assets. I would suspect this default position is going to be that it all needs to be stripped back unless you can really justify and have a story around what the future looks like at that point of time. So the warning signs there for everybody is around discussing these issues up front, early, understanding what the variables are, understanding what the exposure is, and coming to sort of a conclusion or at least a thought process that will be updated on a regular basis. In the past, receiving models that are after year end or just on deadline reporting periods and not thinking through these issues on a regular continuous basis is just going to cause issues and delays and frustrations. So definitely these areas in terms of engaging with and identifying what these variables are and updating them as time progresses is going to be important to do that early in the piece rather than a bit later on.
Yeah, no, very good point. Okay, so then we move on to audit implications. So I might hand over to you, George, to talk about some of, I know we started talking about going concern, but we've got a few slides here that you might want to talk about.
Yeah, I just want to cover some of the points from one, reporting point of view, and two, interaction with auditors and what it's going to look like in the next number of months or 12 months, whatever that might look like. And obviously what pops up as a key issue is going concern, insolvency type scenarios. You would have all seen that ASIC recently, probably about a week or two ago, can't recall the actual number of the guidance that was given. ASIC is basically given a 6-month moratorium on insolvent trading. And there's a whole bunch of conditions around that, obviously, and you should be seeking legal advice anyway. But we're starting to, even from an ASIC's perspective, understanding that from a company's point of view, there is going to be, in order for the markets to continue and clients to continue, there needs to be a bit of an understanding about what insolvent trading means over the next 6 months or so. And that's, you can get that off ASIC's website fairly easily if you haven't seen it already. But we sort of start from there and understand that the financial reports have to be done on a going concern basis. David, I might get you to go to the next slide. So what are we looking at? So really we're talking about models, we're talking about cash flow models, and we're talking about a clear linkage between impairment models and DCF models that justify assets, but are also then justifying the cash position of the organisation. And of course, there's always should be a link between the two models. So there's a lot of uncertainties in terms of what's going to be happening over the next 6 months to 12 months. And the things that we're going to be focusing on specifically in these models is going to be around, some of the examples are staff shortages or staff arrangements and EBA agreements, supply chain breakdowns or changes in supply breakups, costing of material services based on resources, reduced stock levels or excessive stock levels, and what does pricing look like in these models, availability of financing, the ability to defer, the ability to seek alternative finance, the ability to move it into different periods or to defer it, the ability to raise capital, get investors in it. Some people are quite buoyant in terms of what might transpire over the next 6 months, and these circumstances create opportunities. So maybe there'll be people and organisations coming out, but that's what we're looking at. We're looking at loan covenants. We're looking at what is happening with banks, interest rates, deferment of, reductions of foreign currency arrangements and trading and recoverability of accounts receivable. A lot of what we have been talking about. But there's no doubt that this is going to be a significant focus area for auditors, and the variability of the components within the cash flow is going to be looked at and scrutinised a lot more significantly through that. Dave, can you go to the next slide?
Yep.
So I think there's a lot there that are going to be pretty obvious and is going to need a lot more attention. But the question then comes, well, how does that impact, one, on the disclosure, and two, what that might impact on the audit opinions that are going to be issued, and what might we be seeing? And then I think importantly, and I think sometimes this is what is forgotten, is how that opinion will now impact on stakeholders. We're either going to get to a position where every financial report is qualified on going concern, potentially, and then it doesn't matter for stakeholders. There's almost an expectation that is going to be in there, or there's going to be, we're going to get to a position where the disclosure of going concern and the detail of going concern and the continuous disclosure of solvency will become a really important thing. And then the auditor's opinion and what we put in our audit opinion and the type of audit opinion will become very, very important. To go to the real extreme, I just want to quote one of the audit standards, which is ASA 705, which is a modification to the audit opinion. And there's a quite obscure paragraph in there, which is paragraph number 10. So if you really want to go and have a look at it, it's ASA 705, paragraph 10, but I'm going to read it. And that paragraph talks about a disclaimer of opinion. So as you know, we can have an emphasis of matter or an uncertainty disclosed in the audit opinion, which some organisations will be familiar with. There may be an adverse opinion where it's pervasive enough or material enough to say, hey, we haven't received the information, or we don't have enough information to make an opinion on it. Therefore, we're going to give an adverse opinion. But disclaimer of opinion, paragraph 10, actually says, hey, you've received all the information and the client and management have actually formed an opinion on it. But I read paragraph 10 and says, a disclaimer of opinion on a financial report, the auditor shall disclaim an opinion when, in extremely rare circumstances involving multiple uncertainties, the auditor concludes that, notwithstanding having obtained sufficient appropriate audit evidence regarding each one of those uncertainties, the auditor, it is not possible to form an opinion on the financial report due to the potential interaction of those uncertainties and their possible accumulated effect on the financial report. So this is a scenario now where it clearly says rare extreme circumstances, which clearly we're probably in and are actually in. And then the scenario says, well, management has gone along and said, well, this is how we think it's going to go and what we think it's going to be. But because of the severity of it and the rareness of it, we still are not going to be able to form an opinion about how those uncertainties may interact. And we're talking about sales, we're talking about inventory values, we're talking about getting supplies, we're talking about all those factors that we have talked about. So it's really just a heads up that in the extreme scenario, there's absolutely And there's a few firms that I've been speaking to who we are starting to talk about that peculiar paragraph about actually disclaiming an opinion. And also in the circumstances where I would imagine most clients or most companies are going to say, look, this is a circumstance, this is what we are relying on, but really there's so many uncertainties. We can't actually form ourselves an opinion, and therefore we'll move towards that sort of adverse audit opinion, but it'll be a form of qualification. So I think that's sort of potentially where we're going to get to. Therefore, it's really important with your relationship with the auditor and the auditors themselves, we are starting to address this issue sooner rather than later and to determine what that impact is going to be. The last point I'll talk about on going concern is then the auditor has a responsibility under Section 311 to actually report suspected insolvent trading to ASIC. So this is going to be certainly a discussion point that most auditors are going to have with the client and the company. And given the circumstances we're in, it's probably going to be a pretty obvious process anyway, but it may not be. But again, conversations are going to need to be had between auditors and boards and companies around what Section 311 means for that entity and the auditor's responsibility to actually report suspected breaches of insolvent trading. Because again, don't forget, the auditor's responsibility is about suspicion of insolvent trading rather than actual insolvent trading. And then I'm going to revert back to my first comment about going concern, being ASIC has already come out and said, hey, our definition of insolvent trading is going to change over the next 6 months. So as we digest what that actually means, then there will probably be a flow-on effect to all the things that I've just said. Thanks, David.
Correct. So what are some of the other concerns your auditors are going to have? So it doesn't stop at going concern then, George. We've got other issues.
Yes, so there's other issues that we need to deal with. And obviously it's the way we sort of engage, how the client or the company and the auditors are going to engage. There's obviously going to be scope limitation overseas and interstate operations and subsidiaries, and there's already been some guidance coming out of the professional bodies around providing, if you've got subsidiaries in Asia, for example, in China, there's a lot of discussions around that, then there's a bit more reporting time provided to certain entities. But there's going to be issues around how do we get information out of interstate, how do we get information out of international companies, how do we address the grouping requirements if you're a consolidated group and the auditor's requirement to be in front of, in the face of, and to see certain information. And I think that's where we're going to have to be a bit more creative about, how video aids may assist some of those locations. And obviously, given Moore Stephens being an international firm, it's going to be a lot easier for us to do quite clearly with our offices around the world. But it's going to be a lot more creative about what does it mean to be on site? How does GPS tracking allow us to prove that we were on site and to see what we need to do? So the lack of physical meetings, I think that's going to be a bit easier to do given video conferencing and dealing with that. So that should be okay. It's more when we get to electronic transfer of data. So far, we haven't seen a significant issue there. Most clients can download data and information. It becomes now an issue of security. So we're starting to see that that's hopefully not going to be as big an issue as we are. But if it is going to be an issue, because there's going to be responsibilities obviously from all parties, we need to be on track of that. And clients need to work with us, and clients need to think about, even within their own world, how data is shared with their own customers and suppliers, let alone with the auditors. Attendance of stock dates, that's going to be a real issue, and particularly when you post from 31 March onwards. In my mind, it's going to be difficult to do alternative procedures because alternative procedures are going to cost money, and that's the last thing that we want to impose on clients, and the last thing clients want to be focused on. So I think there's going to be a degree of acceptance of qualifications in terms of proving the existence of inventory. But again, that's going to be dependent on the stakeholders. If the banks are involved, if shareholders are involved, so there may need to be other creative ways of being able to validate the stocks, and that's something we're working on trying to see it, as well as physical asset sightings. So a lot of what we do, whether it be trucks or significant equipment, we often need to see the physical asset to be able to tick that off. So we're going to, again, be creative with the use of video, the use of GPS in being able to cite some of these assets. Timing and scheduling of audits is obviously going to be a key issue. There was an email that came out from Bargo. I hope they're okay with me saying this, but there's already gone from a government auditing perspective, they've already gone to the Treasurer seeking discussions about expanding the reporting period between July and December and October or September, whatever that might be, extending that out further. So I've got no doubt in my mind that we're going to see, so if that's happening already at a government level, I think ASIC are going to have to be, there's going to be pressure on ASIC to then obviously fall in line with the Treasurer's requirements in terms of reporting dates, and there'll be a bit more of a spread on those reporting dates over the period of time. That's not happened yet, I stress that, but that's what we're all asking for, and that's what we're all needing. And I think that's where clients and organisations and government bodies and auditors are going to have to work together in ways we've not worked before together, in terms of spreading that out over a longer period of time to make sure that resources can be managed, the deadlines can be met, and the economy can deal with all that issue, all those issues. What's not on that list is obviously now what we're seeing is cyber attacks. We're seeing creative ways, if only these people put their mind to good, they're finding creative ways to attack organisations, penetrate firewalls and do some damage in organisations. So the clients and organisations and the auditors' response to cybersecurity is no doubt going to change over the next 6 months. And fraud, we're starting to see the impact of fraud. We're starting to hear some issues. And I think as we progress, we're going to see that there's a lot more issues around fraud and fraud prevention and fraud attacks. So being vigilant around fraud and being vigilant around what our own people are doing. And as the situation unfolds, there's no doubt from an audit and a client and a company perspective, fraud and cyber security attacks are going to be something that's on our radar that needs to be focused on. Thanks, David.
Right. Yeah, no, some really good points there, George. So resources, CAANZ has created a resource page there where you can go and have a look. The ACNC's also got one. We've got publications out, and as I said, if you want to follow us on LinkedIn, every time something new comes out, we're quite regular posters on that. So there are a lot of resources out there. George?
And David, also in the last 3 or 4 days, we've put a lot of information on our website around cybersecurity, managing in financial crisis period. We've also put a lot of information around the packages and the stimulus packages that are coming out from both federal and state governments and also into New Zealand. So there's a lot of that information. So if we haven't already sent it out to clients, and if clients have not seen it on the website and LinkedIn and so forth, there's a lot of good information there. One page is around how to protect yourself, who to be contacting, what discussions you should be having, and just being thought-provoking. And of course, if anyone's got questions, we're happy to take those and assist through that process. Thanks, David.
Yeah, so I mean, that's a really good point, because it is changing so regularly, and there's announcements coming out on, well, if not daily, every few days, that it can be fairly overwhelming to try and work out what's available and what's there for clients. So that's why we put those resources out there. So now we're going to open up the rest of the session to Q&A. We're anticipating quite a few Q&A, but I guess you never do know. So please try and put your questions in the Q&A box as opposed to the chat box. I'll monitor the chat box as well, but the Q&A box, fire through a question, I'll read it out, and George and myself will do our best to answer that for you. Should put a bit of Think music on, George. What's your favourite Think music song?
We must have been very thorough, David.
Yes, yes, or maybe there's some pretty long questions being typed. Here we go. I've got a first question that come through, George. I can answer this one. Will you guys be distributing the slides after this? So we will send around a recording, which will have the slides in. I might attach the slides in a PDF format as well, if people find that useful. So I'll do that. The recordings are typically quite big, so I'll send a WeTransfer link. People might be nervous after what George was saying about cyber attacks and cyber security, but I've never had any trouble with the WeTransfer links. But there are a few people who don't, whose IT block or firewall WeTransfer links. So if you don't get an email from me in the next 24 hours, it means that your IT department blocked it or it went to junk or something like that. So just reach out and talk to me. So I've got a second question, George, which is probably me and you. How do you see impairment testing being handled? And to summarise what I think George was saying earlier, and then you can jump in over the top as well, George, is that this process needs to start much earlier than typically it does. You know, one of the real sticking points, even in a normal year, are around impairment models, DCFs, reasonable and supportable assumptions, and sometimes they get pushed quite back into the audit timetable, which can create issues towards the end of the audit. So I think in this environment, the first thing people need to be doing is thinking about it in advance. The earlier, the better. And then starting that conversation between the organisation and the auditor about assumptions, variables, things that are put in there, so that, you know, we're not left at the end of the audit process scrambling around these things.
Yeah, absolutely, David.
Did you have any particulars you want to add, George?
Yeah, just to add to that, if I'm looking ahead, there's a few things that are quite clear. We're at the moment, there's a lot of uncertainty. So it's going to be best guess and best estimate. There's no doubt about that. And because of that, there's going to be a lot of disclosure, one in the financial report and two in the audit opinion. Whether it's qualified or emphasised, whatever the opinion looks like, there's going to be a lot of information around impairment models and around the financial report disclosure. I think in the past, we probably, you know, sometimes paid lip service to these areas. But given, you know, if you think about your stakeholders and who's reading your financial reports and who's interested in it, we're going to have regulators all over it. We're going to have stakeholders, shareholders, investors all over the financial report. So there's two ways to do that. One is to be, you know, brief and say, okay, well, the law says I only have to disclose that, and that's what you do. Or the other one is going to be detail in that, which then will link to what we're seeing in the director's report. Again, the director's report often sometimes is a bit of lip service. Well, directors only report what is absolutely mandatory. But I reckon there's going to be a lot of stories that are going to need to be told over the next 6 months, 9 months, and 12 months. And that's going to be an important part of it. So the challenge is understanding what are all those variables and how supported can they be, and understand those quickly and make sure there's a consistency between what is in the financial report, what is in the auditor's report, what is in the director's report, and what goes out to market, and how that gets disclosed. And that's going to be the real challenge for all of us.
I think what we do see, George, is some of the notes in the accounts that people have just cut and paste for years on years are now really going to come to the fore. And one that jumps into my mind is that note that talks about significant judgments, estimates, and uncertainties. That a lot of times people just cut and paste a standard paragraph forever and a day. Well, that note now really is hugely important in this environment. And the one that you touched on earlier about, after balance date events or significant events after balance date that, quite often just had nothing to see here. Well, now there's a lot to see here. So, some of those notes that used to be a paragraph that hasn't changed for 10 years now might, be, well, maybe pages is an exaggeration, but, significant. The next question we had was about murmurs about extending reporting deadlines for ASIC and ACNC. I think George started to touch on that. And I know that there has been discussion at the large national networks and also with the accounting bodies about that. So to add to George's discussion earlier, that there definitely has been a discussion about reporting deadlines being extended. The only impediment to that seemed to be that people saying that would then push it into another busy period. So there is a degree of restriction about how far you can extend some of these deadlines. So if you're in October, if you need to report by the end of October, you can probably push it out to the end of November. But once you push it out into December, let's say this crisis has died down, hitting Christmas, and you're hitting 31 December year-end jobs, people have to plan for those jobs, etc. So I think the juggling act, at least from what I heard, was people talking about, well, how much scope is there actually to extend reporting deadlines before you start, biting into other periods. But I think there will be, I'm a bit on George's side of the fence, that there will be some extension. What that looks like, we'll have to wait and see. The next question is, we mentioned cases of data breaches and cyber attacks. What were the impacts of those? And further, what were the reporting requirements in that specific case? I don't think we can talk about specific cases, but there is a lot of information out there where people, and look, I still get emails where people impersonate. I know I've been to a few of these sessions where, people impersonate someone else in the organisation, ask for information or ask to click on links or change bank account details on invoices and supplier things, etc. And obviously, those things can cause losses. I don't know if you had anything to add to the data breaches or cyber attacks, George.
Yeah, certainly what we're seeing is a lot of phishing exercises. So they've been ramped up dramatically. And what we're also seeing is one of the fundamental issues is that staff are working from home. Not all organisations, one can afford to have work-based computers and laptops given to staff to take home. So staff are actually using their own computers. And given the speed in which this has happened, not all computers have been protected in ways that have allowed organisations to protect people working from home. So we're seeing attacks through personal networks as well, then leading on to work-based networks as well. So most of it is phishing based exercises and penetrating through. We have had a few sort of ransomware scenarios fairly recently as well. So it's a lot easier to penetrate through systems and have ransomware. So that's a type of scenario that we're seeing.
Right. Okay, so I don't see any other questions coming through. We'll give it about 30 more seconds and then we might wind up the session. So as I said, expect an email from me. I'll PDF the slides for you, so you've got those in the email, and I'll provide you with a WeTransfer link as well to download the video. Typically, it's going to be a couple of 100 megabytes, so that link only lasts for 7 days, but you can download it onto your own server and watch that at a later date if you so want to do that. So thanks very much, George, for joining me for the discussion, and thanks to everyone who's participated today, and we hope that you stay safe, and we're here to help if you need any assistance.
Thanks, guys.